I see from your note that you're fairly optimistic and you see this as the start of meaningful reform. Do you want to detail your big picture view first?
Yeah, so this shows, see, so far we've been just waiting for the government to feel that there was something very meaningful and large which was necessary, and this clearly is this reflects that government now sees this as a very serious problem which needs some large and structural changes. So I suspect this is not the first one. So if the government has realized that we need, because any economic framework I think needs many changes, not just one, and therefore I think this is just the start of the process. I view it from two different, let's say three different approaches. The first is that India lacks risk capital, right? At this stage of per capita GDP, the nature of savings is mostly in deposits or a very fragmented equity. There is not too much of aggregated equity which is available. So if you need, for example, an example I used in the note that you're talking about, if you need 50 million tons of steel capacity and 200 gigawatts of power capacity, you need at least $100 billion of equity. Now, where will that come from? And aggregating it through the stock markets, because the SIPs etc. are doing well, is not sufficient. Now, what the government has done effectively, and so this shortage of risk capital is something that other emerging markets at this stage have done it through exactly what we decided not to do, which is socialize the losses and privatize the gains. So in China, for example, the banks give a lot of loans. The loans that work create billionaires. The loans that don't work, then the losses get spread out over all the depositors who are paying 2% interest rate or getting 2% interest rate on the deposits. Now, this is something that we've decided not to do. So where will the equity come from? And the government has more or less decided, see, if you reduce the tax rate, you're leaving 10% extra with the corporates, and this is very important for equity generation. So that's the first thing. The second thing is that this attracts significant FDI. Now, in the last 20 years, every country in the world has cut corporate tax rates. In the last 20 years, everyone has moved to a 20 to 25% bracket. We were the outliers sitting at 35%. So this is a very meaningful change. What this means is that the intent is to attract foreign capital, which is very important for the risk capital generation that I was talking about. Most people don't know that almost 40% of Chinese exports are from foreign-owned firms. And it's very important to attract that kind of capital, and this tax rate, I think, does that. The 15% tax rate for new businesses, new companies, is a reaction to what's been happening in Southeast Asia, that as companies start to explore moving out of China, countries are competing to attract them, and this is a very welcome reaction to that the government means business. The third aspect is that you have say 145,000 crores, 1,45,000 crores, 1.45 trillion rupees. Either the government spends it or the companies spend it, right? So it's just a transfer. It is a lack of a transfer now. Now, the government, in terms of capital formation, I think has kind of run out of ideas. So how many more highways can you plan and build? As we are seeing, they're starting to see that at the current pace of growth, at the current level of GDP, some of those roads may not be viable. The railways, though there is enormous capacity to invest, or the potential to invest, the ability to spend faster than 1.6 trillion rupees a year, which is several times what we did 6 years back, but still, that's not big enough. So what will the government do with this? And therefore, it is much better to leave it with the corporates. And I don't think this will get invested very quickly, because the companies that are deleveraging will accelerate the deleveraging. The companies that are sitting on surpluses anyway had no avenue to invest, so they're not investing. But over the medium term, this allows for the equity capital to accumulate, on which the companies can build their investment case, even if it is 2 to 3 years down the line. So that we do not have the pyramid cases that we had in the last cycle, where people borrowed at the parent level and made that equity at a subsidiary level. So when even at the whiff of a downturn, the whole house of cards collapsed. Now that kind of situation can be prevented if you allow this equity to accumulate in the companies, and the most obvious impact of that is in the banks, where the fast-growing banks every few years need external capital. I think the necessity of that goes down significantly because of this.